G'day legends, and welcome back to the Gold Jumper channel, the best place for your daily metal fix. Jump up and under, let's get into it, because the gold market has been a bloody ripper this week. Today we are diving into the wild price swings, from March 8th to March 10th, 2026. We will break down the Iran war chaos, the massive crash in oil, and those sneaky technical indicators. Plus, we are checking in on what big shots like Warren Buffett and Peter Schiff are saying about your stash. Just a quick heads up traders, this is for entertainment only and not financial advice, so keep your wits about you. Now, here is the big question. Do you reckon gold is heading to $6,000 or is this just a fake out? Let me know in the comments below, and don't forget to smash that like button and subscribe to join the crew. Looking at the charts from March 9th, gold started the day at $5,146. It was a proper roller coaster, as we saw prices dive all the way down to the $5,000 mark. But like a true blue Aussie battler, the gold price found heaps of buyers waiting at that psychological floor. By the time we hit March 10th, the shiny metal was back on its feet and trading much higher. We saw gold holding steady between $5,170 and $5,180. This resilience is a massive signal because it shows that big institutions are not letting go of their bars. Even with all the noise in the global markets, gold is holding onto a gain of about 20% this year. We had some wide-range fluctuations at these high levels, which usually means a big move is coming next. Most traders are watching that $5,200 level like a hawk to see if it holds as support. No dramas in the dip, just more room in the pouch as we prepare for the next leg of this golden journey. Now let's talk about the geopolitical firestorm that has been shaking the world over the last 3 days. The war between the United States and Iran escalated with thousands of strikes hitting critical leadership sites. The Strait of Hormuz is effectively shut down, which is a total disaster for global energy and trade flows. On March 9th, President Trump sent shockwaves through the market with some pretty contradictory comments. He claimed the war was very complete and could end soon, but the Iranian side said, "Not so fast, mate." This back and forth caused a massive tug of war for safe haven assets as traders tried to price in the risk. Every hour of uncertainty provides a solid floor for gold, because nobody wants to be caught empty-handed. If a real ceasefire deal actually happens, we might see gold pull back to that 5,052 level. But for now, the risk premium remains high because the asymmetric swarm fleet in the Gulf is still active. Gold is reflecting a world that has fundamentally changed, and the safe haven bid is looking structurally supported. Moving over to the energy pits, WTI crude oil has been absolutely mental over the last 48 hours. After Trump hinted at a quick resolution, oil prices plummeted by a staggering 28% on Monday. By March 10th, we saw WTI trading around $88.57 per barrel. That is a massive drop from the highs of $120 we saw earlier in the conflict. The Crude Oil Volatility Index, or OVX, is still screaming above 100% right now. Implied volatility reached over 127%, showing how sensitive the oil market is. Usually, when energy prices tank, it hurts gold because inflation expectations start to cool down a bit. But gold has stayed remarkably steady, only trading about 0.8% above its recent lows. This divergence shows that gold is watching the macro signals while oil is just reacting to the supply shocks. Traders should be alert for a rebound in oil if the Strait of Hormuz stays blocked for much longer. Over in the United States, the US dollar index, or DXY, has been showing some serious muscle. The DXY is hovering around 99.50 as capital flies into the greenback for safety. But some legends like Ray Dalio reckon this dollar strength is just an illusion against even weaker currencies. The US economy is facing a real stagflation trap with rising prices and a slowing labor market. We saw a surprise jobs contraction of 92,000 in February, which has put the Fed in a corner. The market is betting 95% that interest rates will stay between 3.5 and 3.75. Inflation is sticking around 3.4%, which is way higher than the 2% target they want. If the upcoming inflation data comes in hot, it could supercharge the gold trade even more than before. Gold acts as the ultimate hedge when the central bank can't decide between fighting inflation or saving jobs. It is a win-win scenario for the metal, because either outcome usually ends up weakening the fiat currency. Let's bring it back home to Australia and see how the lucky country is holding up in this madness. The Westpac Melbourne Institute Consumer Sentiment Index edged up 1.2% in the month of March. It reached a reading of 91.6, which is actually a 3.5-year high for Aussie confidence. This surge comes despite all the concerns about the global economy and the war in the Middle East. Aussie consumers are feeling a bit better because real incomes grew by 3.7% over the year. The Q4 GDP data showed the economy expanded by 0.8%, which is a solid result. Productivity also bounced up by 1%, helping to slow down the rising costs for local businesses. But there are still heaps of caveats because household consumption was a bit softer than most experts expected. The RBA is watching these numbers closely to see if they can finally start cooling off the interest rates. For us Aussie traders, a stronger local economy could mean more support for our domestic gold mining stocks. Time to look at the technicals and see what the charts are telling us about the immediate future of gold. On the daily chart, gold is in a confirmed medium-term uptrend and holding above all major moving averages. The RSI is sitting between 58 and 61, which means we have momentum, but we aren't overbought yet. Bollinger Bands show that volatility is still high, with a range between 5,050 and 5,200. We saw a Morningstar doji formation near the 5,052 zone, which is a classic bullish reversal signal. On the 4-hour chart, gold is moving inside a narrowing symmetrical triangle pattern that is ready to pop. If we get a clean close above $5,200, it could trigger a massive wave of buying. The immediate resistance is sitting at $5,208, so keep an eye on that level. If we break through, the next big target for the bulls is $5,288. From there, the path is wide open to test the old record high of $5,595. Let's talk about moving averages, because the trend alignment is looking absolutely beautiful for the long term. The 50-day simple moving average is way down at $4,814, providing deep support. The 200-day average is even lower at $3,969, showing the bull trend. We have a golden cross active, which is when the 50-day average stays above the 200-day average. There is no sign of a death cross anywhere on the daily chart, which keeps the bears in their caves for now. The 20-day simple moving average at 5,048 is acting as a shorter-term structural floor. As long as the price stays above these averages, the technical bias remains strongly to the upside for traders. Short-term traders should watch the 1-hour chart for a support flip around the 5,165 level. If that level holds, it confirms that buyers are in control and we are heading for higher liquidity zones. It is a buy-the-dip market right now, with major banks forecasting targets as high as $6,000 this year. Even the legendary Warren Buffett has been dragged into the gold debate as prices hit these crazy new peaks. Buffett still isn't a fan of the yellow metal because he prefers assets that actually produce something like corn. He famously said he would rather own all the farmland in the US plus 16 Exxon Mobils than a cube of gold. But even with his skepticism, the gold cube he talked about has increased in value by billions over the last year. While Buffett sits on his cash, gold has outperformed the S&P 500 by a massive margin in 2025. He calls gold a way of going long on fear, and boy, there is plenty of fear to go around right now. If you are a value investor like him, you might look elsewhere, but macro traders are loving the golden gains. Billionaire Ray Dalio is on the other side of the fence, calling gold an absolute investment necessity today. He warns that we are in a late-stage debt cycle where the value of fiat currencies is melting away like ice. Dalio reckons the rise in gold is a warning message to everyone that the financial system is starting to crack. He notes that gold's 65% return last year shows that stocks are actually losing value in real terms. When the real value of the dollar drops, you need a hard money anchor to keep your portfolio from sinking. Dalio believes that hedging currency risk through gold is no longer an option but a requirement for survival. He is watching the global shift away from the dollar and sees central banks loading up on gold at record rates. Peter Schiff is also out there making some bold calls, predicting a financial crisis in 2026. He says the current rally in gold and silver is just a harbinger of a much bigger collapse coming for the dollar. Schiff has set a target for silver at $100 an ounce, driven by industrial demand and fiat failure. He believes the current pressure on gold is just a temporary state of panic that creates a massive entry point. According to Schiff, any stabilization in the war will only push gold higher because the debt problems remain. He is telling everyone to stop looking at the short-term noise and focus on the structural strength of metals. Kathy Wood from ARK Invest is bringing a digital perspective, comparing gold to the scarcity of Bitcoin. She notes that while gold has surged, Bitcoin has been showing an independent trend as a maturing asset. Wood argues that Bitcoin's mathematically metered supply makes it a superior scarce asset in the long run. She expects the US to become the crypto capital, providing a steady floor for digital assets alongside gold. But she also acknowledges that gold's recent rally is driven by global wealth creation outpacing the metal's supply. Whether you like digital or physical, the theme for 2026 is clearly all about owning scarce assets. To summarize the main points, gold recovered from $5,000 to $5,180 this week. The Iran war and the closure of the Strait of Hormuz are providing a massive safe haven bid for all traders. Oil prices crashed 28% after Trump's comments, but gold showed incredible resilience and stayed steady. The US dollar index remained strong near 99.50, but stagflation fears are starting to bite. Australia's consumer sentiment is at a 3-year high, showing that Aussies are keeping their heads up in the storm. Technical indicators like the RSI and the Golden Cross are confirming that the primary trend is still very bullish. Big investors are split, but the consensus among macro experts is that you need a hedge against currency devaluation. The structural floor at $5,052 is the most important level for you to watch this week. So, legends, back to the big question. Do you reckon we are seeing the end of the dip or the start of a crash? Get those comments in and let's get the discussion going, because I love hearing your takes on the market. Make sure you like and subscribe so you don't miss our next deep dive into the golden pouch of profits. We will be keeping a close eye on the US inflation data and any new headlines coming out of the Middle East. Remember that volatility is your friend if you have a plan, so don't let the short-term noise rattle your bars. Gold has been the ultimate store of value for thousands of years, and 2026 is proving no different. Stay disciplined with your position sizing and always keep an eye on those key support levels we talked about. The market might be noisy and sideways right now, but the underlying buying pressure is absolutely massive. Central banks are not slowing down their purchases, and that is a signal you simply cannot afford to ignore. We are in a new geopolitical era, and having a bit of insurance in your pouch is looking like a genius move. Thanks for tuning into the channel today. It has been a bloody legend of a session with all of you. Keep your charts clean and your trades sharp as we head into the next few days of high-stakes action. Stay active, stay legendary. Catch ya!